Welcome to our summer check-in. I'm your host, Ewan Jones. We're now through 6 months of the year, which is a good time to reflect on how 2026 has played out so far. It's also an opportunity to check in on the investment team's longer-term views. They outlined these in their annual investment outlook back in December. So joining me today to update us on their perspectives are three key members of the investment team. We have Packham Breton, Head of Portfolio Management. We have Scott Gardner, Investment Strategist, and Bola Onifade, Portfolio Manager. So first up, we have Packham. Welcome back.
Hello, Ewan. Pleasure to be here.
So before we get into the sort of longer term asset class views, let's take a quick look at June.
Yes.
How did financial markets fare over the month?
Well, it was a mixed month overall, especially for equity markets. We saw the US equities actually, driving down world, global equities in general, slightly negative for the months, and it's driven by your technology stocks, which gave back some performance after two very strong months, which were April and May. So not totally a surprise.
Yeah.
We saw some markets that were positive, Europe in particular, the UK and as well Japan. So that's it's, as I said, it's a bit mixed. And as well we saw extreme level of volatility in emerging, with China down quite negatively, almost double digit, and in South Korea some extreme volatility with big swings on a daily basis. Among other asset classes, in fixed income, we saw actually UK gilts having a decent month, outperforming US treasuries. And a big story around the dollar, which was up 2.5% for the month, which is a very big month for currencies, and outperforming against all major currencies. And it's a reversal about what we saw earlier in the year. And it was helped as well by oil prices going down on the month.
Now, a big topic as well I've seen in the news has been IPOs, initial public offerings. What do you think investors need to know about that?
Well, first, it's a very massive news. We've seen SpaceX having its IPO in June, the biggest ever. So it's the size of the company is now around $2 trillion, which is massive. But only a small portion of that was put in the market. So that helps as well to make the IPO a success. And as well, there is a very strong pipeline of other gigantic companies, especially on the artificial intelligence front.
Yeah.
Anthropic, OpenAI are likely to come in the market in the next few months. And it's actually almost having like Amazon, Facebook, and Google having the IPO all within a couple of months or weeks. So it's a pretty massive.
Because they're very significant companies. They're very large.
Yes, exactly. I mean, basically, we don't have any we don't have the same one in Europe. For example, no company in Europe is close to their size in terms of market cap overall. So those are very, very big. One thing to know is, of course, in the short term, they can be extremely volatile in terms of price. There is a lot of price discovery as they go into the market. Valuation can be exuberant. SpaceX, there was very high demand. The valuation was extremely high. So I think people should be a bit cautious in the short term. But mid-term and long term, we can really think that they're going to be, very important in terms of, new joiners to the market.
So week to week, there's always something new that's trying to grab our attention. If we zoom out and look at the first half of the year as a whole, what do you think the biggest theme is that's actually broken through for you?
Yeah, I think looking back in the first part of the year, there were really two themes that really mattered the most. One was, of course, the war between the US and Iran. And the second one is the very strong earnings cycle, especially in the US, but as well in emerging markets. If we start with the war, it started at the end of February, and really it had a big impact on oil prices with the blockade of the Strait of Hormuz. And as well, this has ramification to inflation and risk of inflation going forward.
Yeah.
And that's really the key point, which is if it impacts potential, bond yields, it impacts how central banks needs to manage their monetary policy, and that's really, that was really an important shift, because we were expecting, and everyone was expecting bond yield to go lower over the period, and this changed a bit the outlook on that front. The second one, and it's a bit less, discussed overall, is really the earning season. We had very, very strong earning quarter, and basically that's really helped corporates overall, and basically to have a positive view on the market.
And those strong earnings, they've really supported equity markets, haven't they? It's been a pretty strong year-to-date period.
Absolutely.
So what is the kind of biggest challenge for you in that kind of environment?
Well, I think the biggest challenge was really the start of the war, and really the rise in oil price, and basically knowing where it's going to impact global markets and the global economy. Right. And I think we saw a lot of asset allocators deciding to really reduce their risk, take some of their allocation out of the table with the higher level of uncertainty. On our side, we kept our allocation roughly unchanged. We were pretty confident that basically we needed to see way more and longer risk to materialize before we were going to see a real risk of recession in the US. So we were really guided about this long-term view that basically a US recession was still unlikely. The earnings were very, very strong. And so we needed to see way higher oil prices for way longer for us to change our view. And it was actually the right call, but it's challenging when you are in the middle of it to know what's going to happen after.
Welcome, Scott. Thanks for joining me.
Thanks, Ewan.
Now, a theme that you outlined back in December in the annual outlook was that US equities, the case for them continues to be really compelling. Is that still your viewpoint?
Yeah, absolutely. Despite the volatile start of the year from the geopolitical standpoint, the US economy has been very, very strong. And this is really driven by the AI CapEx boom that we're seeing take place.
So capital expenditure, that's none of the money.
Yeah, it's capital expenditure. What we've seen is within the first quarter of this year, you're running at a nominal growth rate. So inflation and actually the underlying volumes running at 40%, so 40 year on year. So that is a lofty growth rate. When you decompose that into actual contribution quarter on quarter for GDP, you're running at 0.5%. So it is a decent chunk of growth for the US economy. This has obviously led into earnings growth within the NASDAQ 100, particularly with all that's home of technology names. So what we're seeing there is the NASDAQ 100 was up nearly 17% year to date.
Yeah.
And also what we're seeing is compression in valuation. So people were getting a little concerned about the lofty valuations that some of these names were trading at. What we've actually seen is that due to the strong earnings growth, valuations have actually compressed. So it's a very bullish environment for US equities.
So sticking with equities, but shifting regions onto emerging markets, that's one that you outlined as really being quite promising. Do you still have that positive view there as well?
Yeah, absolutely. So the situation there is the EM space is one of resiliency. So particularly with EM Asia, where a lot of the energy comes from the Strait of Hormuz. So you would think these economies would struggle. But the markets have held up exceptionally well because a lot of what we call AI earners, so those that benefit from the CapEx spending, are here in Asia. So you're looking at Korea, Taiwan, even Japan. So these are the beneficiaries here from all that capital expenditure taking place. So it's still a very robust environment here. There has been some more volatility of late, especially in Korea.
Yeah.
It's something which we are watching closely, and we are taking steps in the portfolio to manage that.
So switching to bonds, the expectation was for more normal this year. Can you briefly recap what that means and also just bring us up to speed on the team's view?
Yeah, so in terms of quote unquote normal, it's more around bonds performing their traditional defensive role in portfolios. So being there for capital protection, but also income generation.
Yeah.
So we did see a little bit of that to start the year, but what then happened with the Middle East dynamics with the Strait of Hormuz closing and the resulting spike in energy, the inflation component of the bond yield had to expand to compensate for that uncertainty and the risk. So what's happened there is that perpetuated around the world. So we then had previously a easing bias, so cutting interest rates or holding things steady, to a tightening bias, hiking rates.
Yeah.
So what's happened here is the European Central Bank, just a few weeks ago, hiked their base rate by 0.25%. In addition, we've also had the Bank of Japan continue their normalization approach. So they're now at 1%, which is the highest since 1995.
Wow.
Now, closer to home with their Bank of England, there were hikes priced in.
Yeah.
But as the events with the Middle East have unfolded and the MOU, the Memorandum of Understanding between the US and Iran, that's actually compressed that inflation expectation. So now there's no hikes expected this year. And it's a similar dynamic in the US as well.
Welcome, Bola. Thank you for joining me.
Thank you for having me.
So let's talk commodities, specifically oil. Now, this is something we touched on with Scott and Packham earlier on, but higher oil prices have been something that's been pretty visible in the news. What is your take and what has kind of surprised you over the first 6 months of the year?
Yeah, so that's a great question to start with. I think coming into the year, we had this sort of view of price compression as the year rolled on. And that was really because of a supply glut that we saw incoming into the first half of the year. Now, obviously, our expectations were upended because we had the tensions kick off in the Middle
Yeah.
East, and that saw oil prices spike. Now, as we look forward, what we should see is that spike should start to really calm down. We've actually seen the first signs of this take place.
Yeah.
Our oil prices now are in the low 70s. So we should see that really continue to feed through. And what that means for inflation is that even though, where we saw inflation we saw it quite contained into the transport sector, that impulse should really start to dissipate as we enter the second half of the year.
So changing tax a little bit and looking at the political picture. Now, changes here in the UK have been front and center in recent weeks and months. What is your take, and what do you think investors need to know on this topic?
I think what we have our eyes on as investors is really the sort of two sides of the balance sheet for the UK government. So how is the government going to be facilitating growth and investment and sort of balancing that with like responsible spending? That's something that has been plaguing the UK government for quite a while, but unfortunately, the UK government is not unique in this position. We have same questions or similar questions about the US. We have similar questions about France and Japan. So these sort of trends are things that I think as investors we need to see governments start to sort of put front and center in their thinking around how to stimulate their economies.
So just appropriately balance that spending with the tax take.
Correct.
So if we look at financial markets, what do you feel the biggest threat is right now?
Standing where we are right now in 2026, when we look back at what the biggest drivers of equity returns have been, I mean, we can very solidly look into the technology space and see what's happening there. So that's sort of going back to the story of the AI CapEx super cycle that has been the biggest driver, not just this year, but the years prior.
Yeah.
Anything that were to arrest that CapEx super cycle would have massive ramifications. So when you think about equity markets in the US, when we think about emerging markets, Taiwan, Korea, those regions would be very greatly affected if anything were to stop that process. Having said that, we're still very positive on the productivity gains that will be delivered by AI. And whereas, when I think about the equity market, I see the chances of that scenario, that arrestation, I see it quite slim.
So a little bit of caution on that, but still broadly a very positive view.
Yes, as we look onto the second half of this year, I think we are very positive on equity markets, and we see, earnings growth continue to be delivered.
Yeah. That wraps up our summer check-in. Thanks go to Bola, to Scott, and to Packham. We want to make sure these Q&A sessions are as valuable to you as possible. So if you have any topics you'd like covered in the next few months, please do just let us know. You can drop a comment or contact us via social media or email. Until next time. As with all investing, your capital is at risk. The value of your portfolio can go down as well as up, and you may get back less than you invest. Past performance and forecasts are not a reliable indicator of future performance. We do not provide investment advice in this update. Always do your own research.